This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson here with you. Excited to be here with you today. And the day we're recording this is obviously May the 4th. You guys are probably hearing it afterwards. So May the 4th be with you for all of our Star Wars fans out there, our Note Wars family, and our listeners out in Note Nation. Always kind of fun having an extra day to promote or goof around and be something that you enjoy. Like for many of us, the Star Wars movies have definitely been that one, and all the things that have spun off of that have definitely helped a lot of people out there, not only in the movie industry, but also, and everything goes along with that too, but so many great things taking place out there. And honestly, if you're a big Star Wars fan, you probably have, I don't know, maybe you've gotten a passion for Disneyland with everything that going on with all the different rides they have coming out or have with them now taking over the Star Wars franchise. But today's episode, I want to talk about the Force. I want to talk about the Force when it comes to the Note Force and everything that's kind of great that comes from note investing and kind of the different spin-offs that a lot of us real estate investors, especially specifically in the note space, end up seeing and end up happening. And I guess we could start at the beginning with a lot of things on as a new note investor, what to kind of expect, what to look for. If you're looking to get into note investing, and there's been an increase, obviously, in interest or peaking of interest, I would say, with real estate investors who've come from the fix and flip side, the REO side, the lazy landlords, the out-of-state owners, and wholesalers, and everybody else out there that's trying to buy, I guess you could say, the end product of notes. What do I mean by the end product? I mean properties that we have taken or that the banks and financial institutions take to legal. They take it to the foreclosure route. They take it to the auction site. And here in Texas, the first Tuesday of the month, which will fall on tomorrow here after we're recording this. Well, we probably won't have anything because obviously everything's been delayed a while. But normally on the first Tuesday of the month, we have the foreclosures. And that's kind of an exit that happens for many of us as note investors, but that's the beginning phase for many people. And that's the thing. So many people, so many investors get into the tangible side of real estate. They like to flip this house, the flip or flop. They like the idea of the tangible side of real estate, going out and picking up a property, touching it, feeling it, seeing it, and then being able to, use their magic wand, use their force to clean the property up, to rehab it, to regentrify it, and to get it listed on the market to sell it. And here's the thing, is that most people that are doing that, there's a lot that goes into that, 6 to 12 months or longer before ever a property really ever hits the open market like that. And I say it's the open market because that's where majority of investors are used to. That's where the majority of the books have been written. That's where the majority of the real estate classes have come from. It's all on the buying the property. Well, if you take a look back at the trend and what's led to that property getting to the foreclosure auction, be listing as an REO on the MLS with an agent, there's a whole lot of things that happen beforehand that can affect that property or maybe even remove that property where it never shows up. It never shows up to the MLS or traditional fix and flippers. And that's what I tell people all the time. Like, listen, when we're dealing with banks, when we're dealing with asset managers, there's a couple of things immediately that are working in our favor. One is we're going to see stuff 6 to 12 months before your traditional fix and flippers. We're going to get lists sent to us from the banks and the institutions. And it's not so much a property focus. That's where you see a lot of investors come in. Oh, I'm going to focus on one property. I'm going to fall in love with it. I'm going to discover, I'm going to just let my imagination run wild on paint and carpet and white picket fence and landscaping and curb appeal for this one property. And they bang their head against the wall a lot of times fighting so many other investors that get that, especially the weekend warriors, that the wannabes that outbid your traditional investors that have a formula for really making things work, making the numbers work for them. Whereas a lot of the weekend warriors will overbid, and then they find themselves in trouble later on as they over rehab the property. I have many friends that have done that. And I did that initially first on years and years ago, almost 20 years ago. So seeing assets 6 to 12 months before, it's almost like an alternative reality, an alternative in a galaxy far, far away, that we see these assets. We have the opportunity to come in that will never hit the open market for most investors. And that's a very powerful thing. Besides just a whole new wave of deal flow, we also see a lot better pricing. And that's a huge thing, especially with the markets being where they're at with the distressed debt, being at where we're going to see a lot of these defaults, a lot of forbearances, loan modifications that aren't going to work through. There's a lot of things that end buyers will never see with the fact that we can pick up these so many amount of deals, so much better pricing. We're talking stuff instantly at a 30 to 40% discount. Heck, that's why I wrote the book, How to Buy Real Estate at 40% Off or More. Okay. On the magic world of note investing, the note force, as we like to say, the dark side of note investing. Use the force, Luke. And that gets into another thing is, one, so many investors have to hustle. So many wholesalers, fix and flippers, landlords, they have to get in. Once they've bought a property, they've got to go out and market and market and market and market and market. I've been a part of different masterminds of the last 15 plus years as a real estate investor. And I've paid a lot of money. And one thing that I always found in joining a lot of these traditional real estate masterminds or going and attending is most people don't understand the note business, which is unfortunate. Everybody's in it. We all, I've said that before. If you've got a mortgage, if you've got a car payment, credit card, any type of IOU, student loan, stuff like that, you're in the note business. You're just on the wrong side of the payment stream. And I've gone to these masterminds and I've talked with people that they're flipping 60, 70 properties a year. And I bring up the fact, well, hey, I bought 60 notes at once, 70 notes at once, 175 notes at once for less than what you're doing with 10 assets. And it just blows their mind. They just can't seem to understand that. The force is strong in this one. What I'm trying to get at is we get so sucked into as real estate investors, we get so sucked into our normal, what we get used to. It's hard to see outside the box a lot of times. And instead of having to chase and find so many borrowers in trouble, I'll give you an example. Our friend Jason Bible, we've had on the podcast here, was talking about how he drops $35,000 a month, or he was previously, in marketing, going out on postcards, going out to distressed buyers, to out-of-state buyers, to people in one area in Houston, in Harris County. That's a lot of money. You're dropping $400,000 a year right there just on the postcard side. That doesn't count the billboards. That doesn't count the classes. That doesn't count the other things that he's doing for marketing as well too. And a lot of those things, don't get me wrong, he's built a great business that way. But him and I have had many conversations that if he had to start all over again, he would start with the note side because it's less demanding. There's less overhead because you're in the debt game. You're miles up the river, all right, miles up closer to the sources of where everything begins, because everybody really, it starts and ends with the bank. The bank's going to get paid in some sort of way. Either the bank's going to originate the loan and start making payments, or if you don't pay, hey, you're in a forbearance. If you don't pay, the bank's going to start the legal side, short sale, whatever it might be. And there's a big note there. We're going to see a huge influx of short sales here in the next 12 to 24 months. Like I said before, so back in November, I was talking about we're going to see a lot of stuff here in 2020. But what I'm trying to get at for everybody out there, if you're listening to this and you're looking for a place to start, you're looking for a place to start learning about distressed debts, to learn about the note business, to learn about the best ways to be making money in real estate, what you need to do is start looking at people that have been around for at least 10 years. You have to look around for people who have been around for a decade. Why a decade? Because a decade means that somebody was going through all the crap that's out there in the previous recession and who made it through that. If there's a lot of people you're going to see getting out of real estate over the next 6 to 12 months, a lot of investors, a lot of realtors, a lot of mortgage brokers, as things hit the fan. Now that leads to a lot of opportunity. And somebody may think, well, why is there opportunity when people are getting out of business? Because look, there's a lot of deals that will be happening in an up, down, or down market. You just need to know how to pivot your real estate business. You need to learn how to pivot. You need to learn when you blow up that first Death Star, what are you going to do with that rock? Okay. You got to learn as you experience and grow. You got to reach out to your Yodas who have been around for a while. Here's where, look, wholesaling is always going to be around, but the more educated the wholesaler is about the property, whether it's a traditional piece of real estate or it's a note deal, the more you know about that property, that note, the more valuable that information is, the more valuable your emails become. What I mean by emails, and the emails that you're sending out to your database, that are more valuable to your buyers lists, and knowing what you can and cannot do with that type of deal. Now, here's the thing. Here's the big thing that I want everybody to listen into on this aspect of things. I might not be your guy. You know, if you are uncoachable, if you're not understanding that the market is changing and you're going to stick to what you're doing, then by all means, stick to what you're doing. Because honestly, if you're not coachable, you're not really willing to change and adjust your things, hey, you're going to be you're going to have issues. And that's not saying we haven't had our issues with deals going up and deals going down, things like that. That happens all the time. It's knowing how to pivot, how to respond to those deals. I have to say this, I'm kind of licking my chops. I'm salivating a little bit at some of the things we're seeing across the board. Now, our biggest goal, obviously, first and foremost, is if we're getting a listing of notes on residential or commercial properties, our always number one goal right off the bat is can we help the borrower? Can we help the person in the property? That's the first thing. That is ultimately the first thing that we do on a regular basis. Hey, do you want to stay? What's the situation? And honestly, most traditional real estate investors, they don't have that in mind. Yeah, no, I'm wrong. They're going to work with people, but their biggest goal isn't, hey, I'm going to take over property subject to and keep the borrower in the property. Or, hey, I'm going to take over, I see this foreclosed list, I'm going to try to get the borrower to work with me so I take the property now. Their goal isn't to keep the people in the property because they're not in the note space. They're on the, hey, I want to take the asset back. I want the asset so that I can sell it and make money. Note investing, honestly here, everybody, is the only type of real estate note investing out there where you can really turn lemons into lemonade. Where a bank's lemons, a deal that goes south, market drops, people go out of work, that becomes lemon. That becomes toxic to a bank. We're going to see an increased amount of banks and lending institutions, especially your lending institutions on the alt-A, the subprime side of things, take a hit. If not, we're already seeing that with lending platforms and lending programs dry up, whereas they used to be very aggressive last year and up just a few, 60 days ago. We're taking those lemons from the bank and turning into lemonade. Really not just lemonade, limoncello, okay? We're adding some kick to it because as a note investor, as a bank, when we buy debt and become the bank, we are making America great again, one defaulted borrower at a time. You may laugh about that, but what I'm trying to get at is if we can get a list of notes in, I'm going to give you an example. Get a list of notes in, and I make an offer on 50 of them and end up, say, with 30 of them after due diligence and pricing and back and forth and markets and doing all our shenanigans. Those 30 assets, as I say, those 30 mortgages, here's the thing that changes. One, if we can negotiate loan modifications, forbearance agreements, trial payment plans with those borrowers, that not only saves that borrower, it saves the whole neighborhood. Let's face it. What happened with a lot of people 10 years ago is when they bought or had a property or were trying to fix it up and the market went south, if for every foreclosure on a block, it affects the neighborhood 10 to 15 grand per house. And when you have a wave of foreclosures, you have a wave of defaults in a specific area, it reduces the value for everybody. I had that happen to me. I bought a house not too far from here. Beautiful house. I was really excited. Value was 300, needs some work. There was a divorce issue. Borrowers just wanted to get rid of it as what they owed for it, right? 180. Needed about 30 grand in upkeep work to it to get it up to where it was perfect. And I was like, man, 300, I could pick it up for 180, be into it at 210 at 70 cents on the dollar, and then get the thing sold. That'd be awesome. Well, I bought it just as the cusp of things went south. I can remember I was still working in the mortgage business. It was like one of my last days, and I went and closed on this property. I was so excited. I just flipped another property and made 40 grand in profits for myself. And a nice chunk of change for my investors that funded that deal for me. We were excited about this deal. And in the next 90 days, as we're working through rehabs and working through getting contractors here, and a wave of foreclosures at that neighborhood. And I watched the values drop from 30 to 270 to 250 to 210 to 180 to 150. And just feeling it now, I get a little nauseous just thinking about it and watching that. And what did I have to do? Well, I sold other things, and I said, okay, I'm going to try to make the best of it I can. I lived in this house while I was rehabbing it. I got rid of other things, sold off, ran other things what I could to bring in income, and I moved into this house. I mean, there was 3 bedrooms that I went into. 5 bedrooms, 4 baths, 4,400 square foot, half-acre fenced-in backyard. Is a huge house. All right, 2 full living areas, big dining room. All right, 2.5 car garage basically. Once we cleaned and painted and put carpet in bedrooms, I didn't need to go in them anymore. And for over a year, I didn't go into 3 out of the 5 bedrooms because I was sitting there trying to wait for the market rebound. I was like, okay, I got to do what I got to do. And that's going to happen to a lot of people out there. There's a lot of people that have bought rental property. There's a lot of people that they bought property to turn it into short-term rentals because that wasn't a desirable thing. But with tourism being down and conventions being down and they, the whole tourism industry in the toilet right now flushing, those types of investments are not valuable. They're not worth anything right now. We don't know what's going to happen. That doesn't say, hey, we rebound and everything goes back to normal by Christmas. That would be I just don't see that happening. And that's the thing to look at. We always have to be looking forward to what's going to happen in 6 to 12 months from now. Did I predict this would happen? No, I didn't predict it would happen. I thought we'd have some things happening, and didn't know where it was going to come from. But that's what I'm trying to get at with everybody here right now. If you're listening to this, you're watching this, what are you doing now that will help you cash in and monetize your actions in 6 months? Now, for many traditional real estate investors, it's the whole point of many people are, oh, hey, I'm going to go, I'm going to drop postcards, I'm going to drop yellow letters, I'm going to go door knocking. Hey, you can make money doing that, but you have to look at if it's going to cost you 50 cents a letter or postcard, at least without even the paper on it, the time to send it out, and you're going to get a 1 to 4% response rate on a direct mail piece, that's not effective. It's not effective at all. Get out. For them to hopefully, that 1 to 4% response rate to call you a week out or greater from the foreclosure auction or the trial, that doesn't work. I've been there. And that's saying, yes, the more you hit them, and yes, the more you hit them over and over and over again. We all know that the best way to really hit distressed borrowers, distressed property owners, is hit them 2 or 3 times the postcard. In some states, you just don't have that. In some states, you just don't have the timing for that. But you've got to start planting that seed now. Where I love the best is that, hey, I don't need to drop postcards out. I don't need to go door knocking. I don't need to send yellow letters. Okay, our marketing budget is $0. Well, I take that, but it's not $0. It's what we pay for email and a cell phone. I call those a wash because you're going to have that across the board, regardless of any type of investing, any type of side hustle, any type of thing you're doing. These days, you have to have email and you have to have a cell phone. So it's all a matter of then taking the time to hit that 80% sales are made after the 5th contact, the 5th touch. Now, we're not talking about, I got to send out a different list every month different borrowers were trouble this month that transferred over from month to month to month. We are hitting the same people. We, I mean us, are sending the same email blast out to the same list of asset managers. So it's easier for us to hit that, that fifth point of contact with an email blast. That's one, if they open it. Secondly, reaching out on LinkedIn. And third, a phone call. That's where probably the rubber meets the road the most part, is how effective can you be in that follow-up basis. That's where the money's made for, and rinse and repeat. Now, that requires people to do a little bit of work. And some people are like, oh, what? I have to do that 4-letter word? Nastiness. I don't want a WORK. And what I mean by work here is, yes, you've got to do the follow-up. You got to market. You actually got to sit down and spend a little time marketing. You got to put some assets in place. And by assets in place, I mean your LinkedIn profile, your logo, your website. These days, you need to have a website of some sort. Even if it's just a landing page, like Elite Pages or something like that, that's better than nothing. All right, you need that really across the board, anything in the 21st century. Note Yoda's here to beam you up. Oh, sorry. Sorry, I did not mean there. That's a difference between Star Trek and Star Wars. There's no beaming up taking place. Sorry. What I mean more than anything like that is that you got to put some assets in place. But that's the thing, everybody. You're going to suck the first time. You say, so what's more effective? For most real estate investors that struggle with a budget, they don't have the money to send out $5,000 or $30,000 in marketing in direct mail each month. You don't? I know that. Been there. So what are they doing? They're sending out 50. They're sending out 100. They're sending out maybe 1,000 if they can initially to try to get that ball rolling, so that, hey, hopefully if you send out 100 postcards or 100 yellow letters, because I know some people are a big fan of the yellow letter program, to get 1 to 4 phone calls. And you're hoping that you have a higher than 25% close rate. Why do you need to have a higher than 25% close rate? Because if you have 4 people call you and 1 out of the 4 does, that's 25%. If you have less than a 24% or 25% close rate, that means you've got to wait till next month to hopefully get 1 lead that you can close on. Now with the note business, hey, do we get a lot of lists in? Yes, we get a lot of lists in. Do we get a lot of opportunities to bid on? Yes. Our close rate is still about the same thing. I say 10 to 30%, 30 to 40% on our end, because we do a good job of follow-up. But for most investors, it's a 10% close ratio or less. The same thing happens if you've been in the REO space. A lot of people will tell you, hey, go make 20, 25 offers on REOs at one time. So that's been around forever. Or you can see more of that. Yeah, you see some more of that. But what does that mean? If I'm making 20 offers and I need a 10% close rate, I'd have to hopefully get 2 to respond. Okay. If you don't piss off the realtors that are getting the bids, that's the thing. There's filters through. Here with us, when we're marketing direct to the banks, we don't have to go through filters. We're either dealing with the decision maker of the bank or the person in charge of the assets that can make the decision or work with the decision board to make things happen. Closer, better pricing, better flow of deals on a consistent basis. Because once we've made that contact with that bank, that asset manager, guess what? We're just reaching out to them on a regular basis. Hey, what do you have this month? What do you have this quarter? And building rapport with those people. I mean, when people come to our fast track coaching, our mastermind training, our one-on-one training, one of the best things that they get when they walk out the door is our list of contacts. We're sending it up an email and say, hey, here, contact these 12 of these 15 asset managers that we buy from or trade from on a regular basis that I know on a first name basis, and tell them I sent you, or I'll tell them I'm sending you, and they're going to send you a list of what they have available. There's nothing like that. I don't know of a fix and flipper. I don't know of a rehabber. Hey, call these borrowers, call these people facing trouble, tell them I sent you. They're going to sign over the property to you. They're going to send you a list of their properties. That doesn't happen. It's a total mind blow up. You know what I mean? It blows their mind because they don't get that. And that's what the beautiful thing about the note businesses is. Once you've made contact with a fund, an asset manager, they're going to have stuff to send you. on a regular basis. You don't have to drop 10,000 postcards. You don't have to drop 1,000 postcards. You don't have to drop 100 yellow letters or 100 postcards. You don't have to go out and knock on doors on your nights or your weekends and hoping you don't get shot at from borrowers telling you get the hell out of the way. You ain't gonna steal my house. Had that happen. Had that happen many times. You need to go back to California. Damn investors. You ain't gonna steal my house. Because that's the emotional side. Don't get me wrong. Do we deal with emotions being in the note space? Heck yeah, we deal with emotions in the note space. We have borrowers that are upset. They haven't paid their mortgage because they've been laid off of work. They got sick. They got divorced. Grandma got run over by a reindeer. Okay, there's a whole variety of country western songs that goes in the note space. But the beautiful thing is, everybody, you have vendors in place. You have servicing companies that are making the phone calls. You have trained professionals that can do the workout for you really a lot cheaper than whatever a rehab would be. Now, do we end up having to rehab some properties? By all means. Do we end up having to clean up the properties? Yes, we have that happen. But the fact is that when we're buying cheaper on the front end, we have that stuff already built in, as long as you're sticking to your numbers. There's some people that don't stick to their numbers and they get trouble. There's some people that over rehab the property, think, oh, I'm going to move into this. I'm like, no, just sell it as is, get it moved. Don't be greedy, okay? Don't be a hog that gets slaughtered because you're greedy. Because you want to make you had the potential to make 5, 10, 20 grand more. And 20 grand might be a little greedy, but you get what I'm talking about. But it's a wash. It's a wash. And that I see people like, oh man, there's no properties at the foreclosure auction this month for me to take a look at. I'm like, well, there's plenty of notes for us to take a look at. There's plenty of ways to get cash. I just spoke with a lady, a real estate investor. We're gonna have her on the podcast here, and I'm gonna be on hers. She was talking about how she's done 10 years of turnkey investing. And she says, I've got my rentals that I've built up, and I only work when I have a vacancy. And I'm like, that's great. And she told me what she's making, and she told me how many properties she had, and I figured out that she's seeing roughly $100 to $200 in cash flow per rental property. I'm like, that's not bad at all. A lot of people would die for that. If you needed $5,000 and you had, if you need $5,000 divided by 5, if you had 25 rentals paying you $200 a month, that's great. Get a lot of write-offs, but you're also dealing with what happens. Not every property is going to stay occupied every month. And now, of course, not every note's going to pay every month. But when you start looking at all the work that people are putting in, this is another thing that I love so much about the note space. When you start looking at what a lot of investors doing with showing up to the fix and flip and having to manage contractors or contractors that flake because they get a higher paying job, or they just like, I've got other things to do. We all know that return on time is one of the most valuable numbers that we can have when compared to return on investment. Many investors, when you start looking at the deals and the money you made and how many hours you put into it, you can get disgusted. I remember I was excited when the first properties that I flipped to make $5,000. And I looked at it and I'm like, wait a second. I started figuring a number of hours that I'd spent on this property and the headaches and being up at night. And I was like, wow, I would have made more on a part-time basis flipping burgers instead of going through all the troubles and trouble. And don't get me wrong. Hey, if you stream it, I know people like, I got to make at least 10 grand. I make 15 grand. And everybody has different numbers. I'm not bad mouthing that. Please don't think that for a second. I'm just simply saying, when you start looking at things, are we working smarter or are we working harder? And we all have ebbs and flows. There's going to be a lot of people working very hard the next 90 days, including yours truly, figuring out where is things going to happen, where are things going to impact us, where are the opportunities lying in wait for us to reach out. You just got to know where you got to go. You got to know what you got available to you. You got to know what's going to sitting out there for you, where to look, how to act. And when I look at everything, here's the asset classes that I believe are going to be hit the hardest. Hotels, motels. We haven't seen hotels and motels really over the last 7 years. There was a big bunch of them that were in default a decade ago, and we're going to see that again. Because what happens when people get laid off of work? They stop their extra travel. They stop their vacation. With conferences going online and teaching, there are so many hotels and motels that are hurting right now because their vacancy. It makes me think I need to reach out to my buddy who owns 2 hotels up here, 3 hotels, and see, because he's in the process of finishing out building another one that's vacant, and his parking lot is vacant. There's a hotel across the street over here. Another buddy of ours is manager at a hotel, and yes, there's a few cars in their parking lot, but nothing at full capacity. Finished up, I think, 2 years ago, a year ago, maybe. I don't know. What I'm trying to get, you're going to see a big wave of those in default. Now, what's the advantage of those? Well, if it's got a, if it's got a national chain attached to it, like Marriott or Hilton or something like that, great. That's awesome. Because that can be something, if you come in and step in and pick it up and you can keep that national flag, great. You've got some marketing behind it. What you're going to see a lot more than anything else is a lot of these smaller mom and pop hotels, these smaller locations that don't have the big branding behind them. They're getting outbeat on, hotels.com. They've got to drop the price down ridiculously cheaper to try to put people, butts in beds. That's going to be hurting. That's the first really big asset class that I don't think people have talked about. Apartments, I think apartments are going to be hit as well hard. Starting to see some mezzanine loans on apartments pop up for some borrowers out there. And I'm interested. I'm like, hey, can I get the financials on these? Do you have anything on these? Because I know when you made the loan, you had to have all financials. Where are you at on this? Where is this stuff here? Because right now, I think it's still too early to be making offers, because I think the market's going to continue to drop. And the idea is here is not to jump in now. Will it come back at some point? Yes, I think it will come back. I was looking at some assets that I bought a few years back. Property I bought in Round Rock, Texas. Borrower owed 150. We picked it up for like 120, 110 maybe, if I remember correctly. Sold it for 125. Didn't make that much, but it was a 30-day in and out deal. Hey, making $8,000 on 30 days is not a bad deal. But now that property is now worth on the low end, it says 200. So over 10 years or 8 years, it's appreciated $75,000. Hey, would love to hold on to it, but the way the market was and where I was at that point didn't make sense to hang on to it. That's what I'm trying to get at, everybody. There's going to be a lot of people changing and discussing how the market is affecting them. But apartments, like I get back to this, we're going to see a lot of apartments that are going to be hitting. And it's going to be a lot of the 100 unit or less. I mean, don't get me wrong, we're going to see distress across the board on all apartments, especially the borrowers aren't paying and continue to go 60 days or 90 days or continue to go further in default or tenants that aren't paying because of them being out of work themselves. So it also, if I was invested in an apartment syndication over the last 2 years, I would also be very nervous as well. Why? Well, what's the exit strategy for that syndicator? Most of the time, syndicator raises capital, unless they've taken over a loan, Fannie Mae or subject to. They come in, they raise capital, they purchase the asset for cash, they work to regentrify it, fix it up, put some amenities in, increase the cash flow, increase the rents up to market rent rates, whatever it might be. And then they get traditional financing on the back end. They go out and get refinanced out from a bank. Once they've got 12 months or 24 months or the numbers have solidified. That's probably has gone. That type of financing has evaporated. That type of financing isn't available right now. And so you either have to look into being, okay, we're going to ride this out for another 24 months until we see the market rebound, or another additional 12 months. They should be looking at like, okay, what do we have to do? Well, we've just got to basically buckle down and hang out for a little while. Hey, that works as long as what you do have coming in pays the bills and pays all the expenses. So you're going to see apartments take a big dip. I think it's part of the reason why our buddy Grant Cardone over there has laid off most of his Cardone Capital people over the last few weeks. He saw the market being. There's no reason to keep them around right now to go buy new apartments when the market's dropped up and when he probably overpaid on a lot of his assets. He'll be fine. He's separated out. He will walk away unscathed based on how everything is set up for him. It just happens, okay? We saw that happen with several apartment investors 10 years ago. Some big names in the industry that we saw a lot of distressed debt. We saw their portfolios hitting the market. I'm like, oh, okay, this is a distressed note with such and such bank. Oh, we see the borrower with such and such company owned by blank. No problem. So if you know what to do, if you know how to capitalize, you know how to reach out, you know how the asset managers at these banks, these lending institutions that hold this paper, that is something to look at. And we bought quite a few smaller apartment loans, regentrified them, or sold them at the foreclosure auction. We took them over, regentrified them, got them working, and got them going. And since we bought it at 50 cents on the dollar, it gave us a lot of flexibility to work it and hold on to that or get rid of it after a while. So that's another asset class. The third class, I think you're going to see an increase in self-storage because as people move out, as people get foreclosed on or evicting, they're looking for a place to put their property, their essentials. And I think you're going to see another influx into self-storage out there. But I also believe there's a lot of people out there self-storage wise who can't pay their rental rate. They're not paying their taxes. They're not paying their mortgage. They're probably not going to pay their storage space for their clothes, their knickknacks, their extra furniture. So you're going to see an increase in some of that defaults as well too. But I think it's an opportunity there because if you come in and you pick up the debt or get preferential financing and subject to, take over these assets, it might be beneficial for you to get some 5-year owner financing from some of these mom and pop owners for you to come in and regentrify these assets and get them back on the board and go through this wave and then either sell off or refinance out once the market kind of corrects itself in a couple of years. So those three big things, you're in motels, hotels, your apartments, your self-storage. We could sit here and talk about office space, but office space, the thing about office space is they've often gone and bought and built the property, usually at such a cheap cost per square foot that allows for them for a while to run on 50% or 70% occupancy. They're allowed to run on that because they've got the numbers because they built it from the ground up. They're not involved in initially needing to cover their cost to stay in business is often lower. Now, I think we're going to see, if you go back to the same thing, you're going to see more. So you're going to have a lot of the big box stores, the malls. I think you saw that J. Crew today filed bankruptcy or Chapter 11 bankruptcy. Your gyms are going to be hit really hard with Gold's Gym, 24-Hour Fitness, and others falling or have already filed BK or in the process of it. What we as real estate investors have to be mindful of is, are there opportunities in something that we see that we can get cheap enough that we can turn around and turn to something else? And I think back to one of my investors early on in my career, Mr. Johnson, who shared the fact that in the RTC days, he bought a lot of vacant office buildings and converted them into other things. And one of his best friends bought a huge building in Detroit for like 10 cents on the dollar for $4 million and turned it and transitioned it into call centers, executive office, and made a lot of money doing that. And that's the thing that I look at right now, like, okay, where are the opportunities? Where are some options to be doing some of these amazing things that can set you up for a decade? There is going to be a huge transformational wealth here in the next 12 to 24 months. Like we saw a decade ago, you can either be in and making lemonade or limoncello, or you can be sitting here struggling to figure out what's going on because you're trying to do business as normal. Now, I've been kind of quiet the last month. We've got a few episodes that we've recorded that we haven't launched, but I've been quiet as I've been kind of sitting here studying things, trying to figure out where we go, where do we pivot, what do we focus on? And I'm starting to see that path like I saw 10 years ago. I look at trends, look at what we were doing 10 years ago. And 10 years ago in 2010, 2008 and 9, what I was doing, I was dialing for dollars, making 50 to 100 phone calls a day. I was reaching out to asset managers on an individual basis. Hey, what do you have? Where do you see? What are you doing? And we're going to start doing that. I'm probably going to dedicate 2 days out of my week to making phone calls to asset managers. Today's a Monday. Here in 2 days, I'll be sending out an email. Well, tomorrow I'll be sending out an email blast my asset managers. And Wednesday, I'll be following up with phone calls for 4 hours. 4 hours of dialing for dollars to those that have opened my email, blast, seeing what they have on their books, seeing if what they're feeling the market is. Now, if I get to 100 people in 4 hours, that's 25 an hour phone call. Let's just knock it down to 20, because daddy's going to need to get up and get some water and run to the baño. You know what I mean? I figure if I can dial for dollars for 40 to 50 minutes, take a 10-minute break, go back 40 to 50, I figure I can hit at least 40 phone calls in a 2-hour period. So I can knock out, hopefully my goal is to make contact with 100 asset managers during this afternoon and see what's going on. Do I know where they're at? No, I don't know where they're at. I don't know what their portfolios are made of. I'm doing the whole shotgun and blast approach. Hey, send an email. If they're opening my emails, I'm going to follow up. That's an extra easy way to hit that second touch point. First touch point, they get my email. Second touch point, they get a phone call from me. Third touch point, we follow up with an email if we can find their information. Or 4, get them on LinkedIn. Now, I'm not going to do those all at once. My goal is to knock through the phone calls I can for 4 hours, and then the evening, follow up with an email blast to those, and then also follow up with a LinkedIn contact if I can find them on LinkedIn if I'm not already connected. That's the 3-touch approach. If you can do that one day out of the week for the next 30 days, that'll start building some momentum for you. If you then can up it up to 2 days out of the week, in 30 to 60 days from now, you'll start seeing a lot more momentum to the point where you'll have enough deals hopefully coming in and making enough connections that other people aren't reaching out to. Because most people aren't going to do what I'm talking about doing. Less than 1% of people are going to be making phone calls and dialing for dollars. I know that because I've seen this for years. It used to be the major focus of our teaching. But what we found is that, hey, once people made enough contacts, they stopped dialing for dollars. They didn't need to do that. That's totally fine. Totally fine once you've done the work. What the unfortunate thing is, most people aren't doing the work. Most people aren't making the contacts. I'm about to get Stephanie to start making some dialing for dollars for me. She was one of the best ones at it. Back over 10 years ago, she started doing it. She started doing short sales. She started dialing for dollars. Yes, she may not like initially doing that. Nobody likes initially doing that. And you're like, oh, he and haw. But when you get into it, oh my God, it becomes effective. OMG, it can be effective. What do you have? What are you looking for? And I think she's probably heard me downstairs because she probably just went, what? She said, what'd you say exactly? No, she said no, because I'm confident in that, Scott. And that's great. That's a beautiful thing. What I'm trying to get at, everybody, is there's so many people on here, so many people listening that have experience that want to do things. If you know what to say, you can learn a little bit about what you're doing, whether it's through our virtual note buying workshop. You can go to notebuyingfordummies.com and get signed up there, notebuyingfordummies.com, or going to NoteCamp, notecamp2020.com. All right, or sign up for the virtual notebuyingfordummies.com and get a ticket to NoteCamp 2020. Start learning. Start going and listening to the back episodes. Start learning to the Note Closure Show. Check out Note Night in America. Check out the NoteCamp podcast. There's so many references and ways for you to learn this business. Maybe you don't need to sign up for a class. If you're struggling, I talked to a new guy this morning, and he's a flight attendant. I don't want to say stewardess because he's not a girl, he's a guy. And his wife works in the rental car industry, which is taking a big, my old alma mater, ERAC. And Max, if you're listening to this, I really enjoyed our phone call. But like a lot of people, they're like, we don't have much money coming in. I got to scrape together this to sign up for a $500 or $600 workshop. I get it. Totally fine. Start off somewhere. Start using the assets that are available out there and start learning, starting to put to work the stuff that we teach. Put to work and learn from somebody that's been around. There's a lot of people out there that are flash in the pans that haven't been in this industry 8 years, 10 years. And honestly, if you're going to learn from some people out there, here's the 4 people I would be learning from right now. Okay? Myself. All right. Sue Nelson. If you like commercial deals or larger apartment deals, Sue is one of the best people when it comes to the apartments and the larger commercial deals. She's phenomenal. All right. If she's not retired and spending time with her 3 kids and downhill skiing for the most part, Sue Nelson's great. And then I would also look at the other 2 people out there. Yes, I'm going to say the people that were probably the Donna Bowers and the Eddie Speeds out there, and myself. Us 4 have been around for a while. Now, I think I teach the best when it comes to non-performing notes because we focus on everybody can deal in performing notes. Okay, is under financing going to be big because people are going to not have the FICO scores or the huge thing? Yeah, you're going to have an increase in that. But when you look at the numbers from last year, where there's only 81,000 really owner finance notes originated last year, only 81,000, and that's down 5 or 6% from the year before. What does that tell you? No offense, 81,000, great thing, but that's a drop in the bucket compared to the commercial notes. That's a drop in the bucket to the institutional stuff. I mean, look, we got to see more defaults like that in the last 30 days. So you can either fight over a small little puddle, or you can jump in and carve out something in the sea of debt that we're seeing, in the ocean of debt that's available, that is available, that is coming available. It's getting bigger and bigger and bigger, okay? The polar ice caps in real estate have melted, resulting in more distressed debt. The market has changed. We all know that. We've seen the writing on the wall. So do something. All right? Learn the non-performing side of the business so that you know how to turn that into a performing note. Learn the non-performing side of the business, of the debt side, so that when you see something that makes sense, that you can convert it, that you can own it, you can take it down, you can make sense with it. Look, I want everybody to be successful. All right. I truly do want everybody to be successful. And I know there are so many opportunities out there for people to be successful. You just have to do the things that most people aren't willing to do. Most people won't send a postcard out. Most people won't make a phone call. Most people won't call banks. Most people won't send an email blast out. Most people won't do anything. But if you want to be most, that's another 4-letter word for you not to succeed. Rise above the crowd and do some things a little bit differently. Spend a little bit time in your night, in your day, in your weekends doing something. One of the things that I'm going to go back and be doing here and releasing over the next week or two is I'm going back in and revisiting some of the assets here in the area that I was responsible for. Some of my first deals that I took down 10 years ago, 12 years ago, 15 years ago. I'm seeing how the market has changed, because that's how you learn. You look at history, look at what happened, and then when you start seeing the trends and things happening again, hey, you move on from there. You learn. You lick your wounds on the mistakes you've made, and you get up to fight another day. You lick your wounds and you keep moving forward. You keep failing forward. So if you're struggling right now, if you're listening to this or watching this or whatever, and you've hit the skids on something, you're laid off, you don't have income coming in, hey, do me a favor, reach out to me. If you think you want to get into the real estate and the note space but don't know where to begin, feel free to give me a phone call. talkwithscottcarson.com. I'm not here to sell you on anything. I'm just here to give you some counsel. I talked with a lady on Friday, Thursday or Friday, I don't remember. And I was like, well, look, you're not for the note business. Your comfort level and what you're telling me and what you're telling me without telling me, stick to what you're doing. You don't need the note space. Stick to what you're doing until you get outside of your comfort zone. Because we as entrepreneurs, we as investors will never grow when we're inside of our comfort zone. I don't care what it is. You've got to get outside your comfort zone more so than anything else. And that includes yours truly. So things I'm doing, like I said, start calling banks again, email blasts as usual. We've done every month in and month out. I didn't do it in April because I was like, there's no reason to. It's too soon. Let's just wait and see where things go. But now this month, yes, first email goes out tomorrow. First round of phone calls takes place Wednesday, and we go from there. And I encourage you all, hey, if you've had issues in the past, you've had some deals go south, you know the best way to go out and solve that issue, go out and make some big changes. Go out and take down some deals. Not only put money in your pocket, but take care of what needs to be taken care of. And you'll feel a whole lot better about yourself versus just sitting here stressing about waiting for the sky to fall. Don't be Chicken Little, okay? Be Darth Vader. Be iconic. Be Yoda. Be Luke. Be Han. Be Leia. Whatever you need to be. The force is available to all of you guys. You don't have to have something flowing through you. You can reach out and take that knowledge and take it and apply it in your business and let the force be with you. So go out, take some action, everybody, and we'll see you all at the top. Bye.